Welcome to Financial Detox. We're your hosts, Jason and Alex from IDA Wealth. Your financial journey of pursuing better and true financial peace of mind starts here.
Hi, and welcome to a very special episode of Financial Detox. I'm Jason Labrum, your host, in studio with my man I'm going for today, Alex Klingensmith, regular and maybe the best co-host on the planet Earth of Financial Detox. But today we have a special show for you, and we brought on a very special guest who is a friend and consultant of ours, Phil Huber. He is from Cliffwater. A very perfect timing for this event. Phil is the managing director and the head of portfolio solutions at Cliffwater. So we brought Phil to you here through Financial Detox, not only so you could learn more about what private credit is and private debt versus public bonds, which we love to educate consumers on Financial Detox, but we brought him here too to help us understand better what's going on in this particular space and the risks and how Cliffwater in general sees it and how other markets see it. So with no further ado, Phil, I would love you to introduce yourself. Thank you so much for being here on Financial Detox. And we're just really glad to have you. Thanks for being here.
I'm glad to be here too. Thanks, Jason and Alex, for having me on.
There's so much noise right now in the space, right? This retail fund redemption panic. People who don't even know what private credit is know that Cliffwater had redemption requests, and the retail investor tends to swing the pendulum from one end to another, right? There tends to be some emotional overreactions. I mean, if you look at behavioral finance in general, one of the things we do at Financial Detox is try to help our clients avoid toxic advice and making bad, toxic financial decisions. And that's kind of an opposite or contrarian to the human emotions and the way we behave. This retail panic and the disruption of software and AI and all the things that are going on. Why don't we, before we dive into some of those details, let's back up. And Alex is even better, way better at me than asking questions. So I'll get quiet here. But
well, I think about these shows that we put on, you guys, and I think so the people that are listening to this tend to back up all the way to the beginning because you guys both speak so well about this. You know what you're talking about. But if I'm having this conversation with a prospective client or even an existing client that maybe doesn't have private alternatives in their portfolio yet, one of the most common initial questions is, Phil, what is private credit? Where did it come from? Why should I trust it? How does it compare to private equity? Because everyone seems to know what or they kind of think they know what private equity is or have some grasp of it. Maybe just start there if you could, and then we'll go fast forward to where Jason was.
Yeah, it's funny. You would think, given the growth that private credit's had over the past, several years, I think there's a natural assumption to those that aren't experienced with it or familiar with it that it just sort of appeared out of thin air a few years ago, and now it's like
Yes.
everybody can talk about. The reality is this is an asset class that's now old enough to have a cocktail. We'll say it's been around for more than 20 years. It predates the GFC, the financial crisis of 2008 through 2010. And so it's existed for a lot longer than people think it has typically. Granted, it's gotten a lot bigger, but there's reasons for that growth. If you think about the GFC, really a byproduct of that, given the distress that it caused everywhere, was that the clear and obvious reaction was that, okay, the banking system, both in the U.S. and globally, was over-leveraged, and I think really that spurred a lot of increased regulation for banks. In other words, a lot of the lending activity to mid-sized businesses that used to take place in the banks ultimately found a better home in the private credit market. So that really post-GFC regulation of banks is really what kind of kickstarted the big growth trajectory of private credit. The parallel trend to that was also the growth of private equity as an ecosystem and this continued preference for growing large businesses to stay private longer or perpetually, as opposed to IPOing and entering the public markets. And so you have kind of the retrenchment of banks from a lot of this type of lending activity because they had to retain more capital. And then similarly, as private equity continued to grow, a lot of what's happening in private credit is lending to businesses that are backed by private equity sponsors. And so that's not all of private credit. There's a variety of different strategies that kind of fall under the private debt umbrella, but the largest by a good margin is what's called corporate direct lending. And this is just essentially, kind of as the name implies, private. So this is outside of the public bond markets. It's outside of the banking system. It was really designed to deleverage banks, not add risk to the system, but rather remove it, because these are direct loans between a borrower and a lender. And the lender is, essentially has pooled vehicles for investors, long-term investors, to allocate money into. And so it's not, based on, taxpayer dollars or anything like that, where there's this, a lot of the issues that we saw in the GFC. And so it serves a really valuable purpose of providing debt financing to companies that represent a significant portion of economic activity in the United States. When we think of where this lending is happening, it's to what's called broadly like the middle market. And what that means in reality, it's about a third of about a third of the employer base in the U.S. is those that work at middle market companies. There's over 200,000 that would kind of fall within the middle market, definition, which it has evolved a bit over time, but generally you can think of it as private companies that have anywhere from $10 million of annual earnings to upwards of $200 million of annual earnings. So these are, not just mom and pop, stores in the strip mall. These are substantial growing businesses that are kind of the backbone of the U.S. economy. So that's really where a lot of this lending is going to, and it's going largely to those that are backed by private equity companies. So
can I back up just 1 second? Yeah. Because there's something I just learned, and you're correcting me, which is, I love. One thing you said was it actually started before you said the GFC, which is the Great Financial Crisis, right? And that was like 2008, 2009. Mm-hmm. I've been telling the story wrong, Jason. I've been saying that actually was what caused private credit to become such a formidable asset class. I got that wrong. You said it's before that even.
You're partly right. It existed pre-GFC, but it was a much smaller size than it was post-GFC, where that growth really accelerated in the subsequent decade plus ahead. Okay. But the beauty of that history is that before Cliffwater became a fund manager, back in 2015, we created an index. That was kind of part of the Cliffwater, particularly our founder Stephen Nesbitt, was very early on in developing high conviction that private debt was going to become the next big allocation in institutional portfolios, and a growing number of managers that were operating strategies in that space. And one of his observations was really that there wasn't a great benchmark to judge manager performance against. And you see this in every other asset class, but at the time it didn't really exist in private credit. And so his view was, if it doesn't exist, let's go create it. And so he created this index that really just tracks the underlying loan performance of what are called business development companies, or BDCs, which have to provide their loan level data through SEC filings. And so even though the index was created in 2015, it has data that goes back to late 2004. And so you have a 21-year history now that really highlights how this asset class has performed, where the returns have come from, how it's weathered different market environments and parts of the economic cycle. It's seen the GFC, it's seen the Euro debt crisis, COVID, the big inflation spike in 2022. So as much as there's a sort of narrative out there that private credit hasn't been tested, but I'd like to think that there's been a number of big world events over the last 20 years that have really I think given it a degree of resiliency and a good track record of demonstrating not only how it performs in absolute terms, but in comparison to other asset classes like stocks and bonds.
That's a good segue, perfect. Jason, for what I was going to ask. I was going to put Jason on the spot. This is good. I can see you're on my left. Phil, Jason's on my right.
Let's go.
And then Phil's going to correct you now, which is going to be great. I learned that I'm partially right, which is always nice to hear. I'm partially right. But as we go through our due diligence process, Jason, when we work with our clients and we build diversified portfolios across multiple asset classes and fundamentals or factors, how do we, Jason, feel private credit? Like, what role does it play in a portfolio? To what degree? To what amount? Depending on maybe the client net worth or tolerance towards this type of asset class. And then please correct him, Phil, if you could find something in there.
Well, two things. Can I ask a question first, and then I'll answer that? But Phil, when you talk about this index, what's the index? What's the ticker symbol, and how can people look that up?
Yeah, well, it's because it's an index, not a product. There's no ticker symbol to look up. It's data that we share with, some folks subscribe to the index, others we provide it to for clients and, things
I
like
can
that.
look up index data for the S&P 500. I can look up index data for a lot of indexes.
Yeah, it's not
like
directly publicly available to anybody, but we generally make it available to our clients that we have, and we have a number of other firms that subscribe to it. But by and large, because it's an index. It's not part of the reason is it's not a daily index like the S&P 500. It's updated quarterly with a lag because you're waiting on quarterly SEC filings of BDCs, which tend to come 6 to 8 weeks after quarter end. But really, what it's measuring is essentially kind of loan yields, credit losses, things like that. So you can really not just look at the aggregate returns, but also underlying credit trends and kind of where the returns are coming from. Is it coming from income, from losses? You can kind of decompose things a little bit, which I think helps people better understand that what this asset class offers over the very long term is it's an asset class driven by income, relative to, say, stocks or private equity, where you're betting on upside and appreciation largely. Here, there's no upside. Your upside is your yield. Your net return as an investor, in terms of how you implement through, allocating to a fund or a number of funds, is a function of what are the actual credit losses in those funds and what are the fees and expenses. Those are the two things that are going to, net out of fund returns over time. And so really that's right. Our kind of viewpoint on the asset class is that while there is a lot of dispersion in terms of manager performance, this is really more of a, again, you're investing for the yield. And so our view is from a portfolio construction standpoint relative to, say, equities, where you get a lot of performance from a handful of names and a small number of names drive the overall returns. And of course, you're investing for upside potential. Here, it's all about downside risk mitigation. And so our view on portfolio construction in private debt has always been more one of try to take a more, market-based approach in a highly diversified, almost index-like way in terms of how you access it, where you're not being rewarded for taking any individual borrower risk. So you want to minimize the risk of any borrower in a portfolio. And if you can invest in a low leverage, low fee, structure, that gives you the best odds for long-term success.
Yeah, it makes sense. So I think I've seen this index in the data, but is there a public-facing version of what you talked about? I know you said there's no ticker. I can't pull it up, but do you have anything that's client-approved material on the index?
Yeah, we have a paper. I just wrote a paper last week that we call The Arithmetic of Direct Lending. I think that's a good way to kind of study and that's on our on our website and on LinkedIn.
We'll tag that into the show.
Yeah,
too.
we'll make sure we get that to your listeners, and I think that does a good job of demonstrating what we've seen historically is that over the long term, you've got about 10% plus of income or yield, and historically about 1% credit losses. And credit losses you can think of as a function of two things: you have default rate and recovery rate. So in other words, even for loans that defaulted, often you see some degree of recovery in those defaulted loans, and that leads to your actual credit losses. So just to kind of use simple math, about roughly 2% default rate historically, about 50% recovery rate, which gets you to about 1% credit losses per year. And that's why the index is over 20 plus years now given 9+% returns. And the loans, probably didn't get to this earlier, but these are loans that are floating rate in nature, so they don't have the same interest rate sensitivity that traditional bonds or fixed incomes do, and they're typically senior secured, meaning they sit, if you think about the capital structure of a business, they sit at the very top, meaning that the senior lender is in the position to be paid back first in the event of a borrower default. And so much more conservative than being in the equity tranche, which again we think helps with long-term downside risk management. When you look at performance in the GFC, the index was down peak to trough about 8%. You compare that to other asset classes like public stocks that got cut in half, high yield bonds, which were down close to 30%, I believe. And then, of course, you had treasuries or investment grade bonds that were flat to slightly positive. And so, but again, our view is because of the senior positioning in the asset class, you've got more insulation from a downside risk standpoint. And when you think about just the math of volatility, the lower the hole that you get in when things go south, the quicker and easier path to recovery you have. And so we saw that it only took about 4 quarters after the trough for direct lending to resume and reach its peak again. So, and that was much quicker than a lot of other public and private market asset classes.
Yeah, it's a good point, and it pivots, and I still promise I'll answer your question, Alex. But
I'm not going to forget, don't worry.
When investors think about chasing returns, which so many investors think about, and they go, the S&P 500 was up 30% last year, so why wouldn't I just buy the S&P 500? Well, it doesn't mean it's going to be up 30% every year. In fact, if you buy it after a year it's up 30%, there's a higher likelihood that you're going to have some down years in the near future than there is up years, because that risk becomes greater the more the market goes up. But conversely, there's times where the S&P 500 is down 9% for a 10-year period. And when you have those negative troughs of those down returns versus a more stable portfolio, your average annualized rate of return can be higher just because you had a smoother journey. Because those troughs, when you're down 100%, or you're down 50%, excuse me, you have to be up 100% to get back to even, where if you just averaged a steadier rate of return, your IRR, your annualized or internal rate of return, becomes higher from that lower volatility. So it's an important part of the portfolio.
Yeah, and one of the points I make in this paper that I referencnced is when you think of, you guys have probably heard the saying, like, stocks rarely return their average, meaning if the average return for the S&P is, say, 10% or a little more over the very, very long term, in a calendar year, you almost never actually get anything within plus or minus 2% of that. I think it's about 2% of the time do you get an annual return that's kind of within 2% of the long-term average. Direct lending's very, very different. It's much more consistent and stable. And so in the paper, I look at the 21 years of the index, and what we found is that about half the time the index return has been within plus or minus 2% of the long-term average. And so to use a kind of a baseball analogy, it's like you're kind of investing for singles and doubles a little bit here. You're not swinging for the fences. And so that, you're not getting home runs, but you're also not getting as many strikeouts either, relative to something like public stocks.
Well, and it's also, you're not investing in singles and doubles in the context of treasuries, 1-year treasuries at 3% yield. Instead, you're looking at more at 9% yield. So that's much more attractive.
Investors need to be mindful of that as well, and that if you look at the historical returns of the asset class being kind of 8 to 10%, we'll call it, like that's a meaningful premium above something like T-bills, but you should take that as a sign that this is not riskless. There's still risk involved. It's non-investment grade credit. And so there is more, risk and downside potential than, say, investment grade bonds. But we think over time, investors are rightfully rewarded, not just for bearing the broader credit risk of these loans, but also the illiquidity risk, because these are not traded loans. They're designed to be held to maturity. And so investors naturally, with any illiquid asset class, command a higher return premium. And so we've seen historically that from a credit loss standpoint, direct private loans have actually had pretty similar loss rates as their sort of public market equivalents like high yield bonds or broadly syndicated bank loans.
So I kind of answered Alex's question, which is what do we think and how do we think this plays into an individual client's portfolio? And it depends on the client, of course. We are big believers in building a cash flow based, interactive, integrated financial plan, which most people at the surface level, if you ask them, do you have a financial plan? If they work with a financial advisor, they'll say yes. And then when we show them our financial planning process, their response is, holy cow, I've never seen anything like this. I've never had this. I didn't know I didn't know that. So I'm like, right, you didn't really have a financial plan. You had an advisor who said they do planning because they asked you some questions and they called that your plan, and it's not a plan. Cash flow based analysis is such a great tool. So when we run that, we can look at the expected risks associated with the client's portfolio and the volatility and the needed or targeted rate of return, and how much volatility do we have to accept to get there. Oftentimes, adding in private credit, which is, again, loans from one person to another, one institution to another, not publicly traded bonds like on the stock market. Or on the bond market. This is a useful asset class that I think creates a better risk return profile for most investors. Is it right for everybody? I would never say yes. But is it right for a lot of people or most people? Probably so. I still didn't get the answer to the question I want, Phil, and you're going to learn my personality here as we go, is I will ask the question the same time in different ways until I get the answer that I'm looking for, which is back to the index and quarterly published index information. Do we as advisors have access to your quarterly? I get you wrote a paper and that's great. We're going to disseminate that. But do we as advisors and or do our listeners as the public have access to your quarterly published index data and information related to that?
Yeah, unfortunately not for the general public. It's not readily available. But for advisors, there's access to the index data.
You answered my question. Beautiful. So here's the reason why you may want to consider having a fiduciary advisor and somebody in your quarter for the low costs that we typically charge. If we can't add value 1, 2, or 3, 4% to 1, 2, 3, or 4% to somebody who hires us, Phil, talking to you kind of as an innocent bystander here, something's wrong. And one of the ways we add value is companies like Cliffwater, companies like BlackRock, they get to share information with us that they cannot share to the general public. That's useful and helpful. There's contextually a lot of information that's available. So we will decipher these quarterly index reports that come from Cliffwater. And I knew the answer to the question already, Phil, but I wanted to publicly state it. Like, we get that information and it's valuable information that then we can pass on to our clients in the right context that aligns with them and their specific goals and their specific objectives, not in an AI context where it gives you an answer, but maybe it doesn't understand the full context of how you asked it because maybe you didn't ask it right. So not dogging on AI because we think it's great, but cool. You answered that question. Alex, did I answer your question about?
No.
Oh,
no,
shoot.
But I'm going to ask it. I'll ask it a different way until I get my answer.
Do it.
So pretend this time like I'm a client. I'm a current client, and I've never owned private alternatives, any kind of private alternative before, for whatever the reason is. Maybe I'm a newer client, and so the first stage of my kind of like IDA experience was to first get my financial plan dialed in, get to know and build trust with the advisor team. Now you're like, okay, we've got the investment strategy dialed. We know your target rate of return that lines up with your financial plan and your goals. We know you intimately, and you know us intimately as well. Now you're going to say, okay, we need to advance evolve your investment strategy to the degree. I'm a $15 million net worth client. I've got $5 million with IDA. My other 10 is outside that with my house, my rental property, my business maybe. What do you recommend, my advisor, and why? And where does private credit fit into that?
I want to refrain from talking about specific products also that we offer, but we believe consequentially, defendably, with data that it makes sense to have alternative investments. That includes private credit, that includes private equity, maybe infrastructure, private real estate, and lots of different subcategories within each one of those headline categories. We believe there's consequential evidence that should be part of your portfolio. If you are interested in achieving the highest potential return for the least amount of volatility. No guarantees. I'm not here to guarantee that that's going to improve your outcomes every day or every year, but we believe that there's enough data to support that makes sense. So yes, you as a client, welcome to IDA and the family.
It feels great to be here. Thank you.
It's going to be a great experience.
I love the welcome wine that you sent me. My wife loves Pinot Noir. So.
We absolutely will build your portfolio in a way that will somewhat mimic and or act like a much more sophisticated portfolio than a traditional retail client. You look at endowments, you look at other institutions, sovereign wealth funds, family offices, ultra high net worth, who have teams of very sophisticated, smart people designing investment policy statements and structures for their portfolio. And there's almost always components to alternative investments, private equity, credit, and so on and so forth. So yeah, we're going to build it in probably to the tune of somewhere between 15 to 30% of your portfolio, depending on your liquidity needs. And that's the right thing to do. We would almost not take you as a client. It would be debatable if we would even want you as a client if you're unwilling to accept that advice, because you wouldn't be allowing us to do what is in your best interest.
Okay. I love I'm a client. I'm stoked. This is wonderful. Now I want to kind of drill down and push hard on this one asset class that I don't know much about maybe, but I've only heard maybe negative things. Maybe I haven't heard anything. I don't know. Now, what specific risks are there within this specific asset class of private credit? Now that I know it's part of my strategy, which I'm on board, I'm cool, I'm good. but now speak to the risks, the temporary, maybe short-term-ish ones, even the long-term ones, if this becomes a stable asset class long-term, like the other ones have sort of proven to be for decades.
So that the main access points to private credit come in a number of different fund structure types. When you look at how institutional investors typically allocate, it's through what are called drawdown funds. Those often carry very high minimums, and you have to meet certain investor qualifications just to be able to even use them. And so you tend to see those less so in individual investor portfolios and more in big institutional portfolios where they can write very large checks and are comfortable with those structures that have a lot more operational complexity involved in them. What we see more for individual investors is either accessing through interval funds, which is what we do at Cliffwater, or what are called BDCs, business development companies. Those come in two forms. You have listed BDCs that trade on public markets, but those also have some wrinkles to them in the sense that they can trade at big discounts or premiums to the underlying net asset value. They tend to be kind of high fee, more leverage, and kind of have more equity market risks associated with them. And so for investors that are investing for consistent income and kind of portfolio stability, those might not be the best route. There's also private BDCs, which are more similar to interval funds in that they offer periodic liquidity for investors. So the way to think about, I'll generalize here a bit just so I can kind of combine interval funds and private BDCs together, is that the way their funds they're called semi-liquid funds. And so even though the underlying assets are these private loans, which are illiquid and don't trade on an active secondary market, the portfolios or the funds themselves offer investors typically quarterly opportunities to redeem out of the fund, but subject to limitations. And so what you find most commonly, and particularly for interval funds because it's required, is that the fund manager has to offer to repurchase each quarter up to 5%, or at least 5% of the fund's outstanding net asset value. So not 5% of each individual investor, but essentially 5% of the fund as a whole. And so long as investor redemptions are below 5% in aggregate, every investor who sought to redeem gets 100% of their requested amount back. What you're seeing kind of most recently in the past quarter was that tensions are higher, there's negative headlines, and so as expected there's more people redeeming. And so what can happen in these funds is that if more than 5% of aggregate investors are seeking to redeem, then investors may be prorated for a portion of their requested capital. So if they submitted a redemption for 100% of their allocation, maybe they've only gotten 50% of that back this quarter, and so they need to come back in another quarter if they want to continue to redeem out of the fund. And so these are mechanisms in place specifically to protect remaining investors and the underlying portfolio integrity. There's a lot of organic liquidity from private debt in particular, because these loans tend to have an effective life of 3 to 4 years. Mm-hmm. And so in a given quarter or a given year, you get typically more than that 5% just from loans repaying early or maturing. And so there's a natural organic liquidity to the asset class that helps support quarterly investor redemptions, but there's not always that. So you also have to have other available sources of liquidity as well. And so the best funds have put a lot of effort and resources into building out liquidity and liability management capabilities to make sure that they're in a position to withstand an extended period of outflows without becoming a forced seller of assets. In other words, they've got enough levers they can pull from a liquidity standpoint. It could come from credit facilities, cash they have on hand, and just the organic liquidity of the underlying loans that can help support that 5% per quarter. But
so one of the cons you're giving me actually could be a pro in some ways, because it actually smooths. That's kind of the reason why there's less volatility.
And I think the con is that for investors that really place a high value on having on-demand access to their portfolio 100% all the time,
you should not own this.
Whether it's private credit, private equity, private real estate, this is capital that belongs in the hands of patient long-term investors.
Right.
And so if you're the type of investor that's going to have knee-jerk reactions to headlines or have second guess your decision and then be in a position where you want your money out but you can't get all of it at once, probably best to maybe reassess your decision to allocate. Private markets aren't necessarily for everybody. Like you guys, we at Cliffwater believe, strongly, we've got a whole business built around it. The power that these asset classes we feel can add to a portfolio to enhance income, to enhance, total returns, diversification for a broader portfolio. They're not a replacement for traditional assets. They're a complement to traditional assets, but there's trade-offs involved. You're sacrificing liquidity. You're typically, there's typically higher fees. There's a little bit more complexity. And so those are trade-offs investors have to keep in mind when they're trying to assess what role that alternatives can play.
Which is why I appreciate Jason's response that it's a part of, that this is a part of the portfolio that is the private alternatives.
A part of the part of. Yeah.
The other question that
I would slice.
Yeah, exactly. And I appreciate that as that client that I was role playing as. The other question I want to make sure we get to before we're out of time, Phil, is what do you, this is an impossible question to answer. I know this. And so with as compliant as possible, when you think about the time frame that this has been a reliable asset class with expected returns and expected volatility, expected being the key word, how does it look long term, another decade out, 2 decades out for our clients that are thinking 20, 30, multi-generational even, right?
Yeah, I think investors can, what we've seen in the data from our index now is, that pretty consistent, 8 to 10% return over, meaningfully long enough periods, 3 or more years. There's going to be the occasional negative year. There's going to be other years where maybe you're, instead of the 8 to 10, you're getting kind of more mid-single digits. But conversely, there's going to be some years where, we saw this in 2023, 2024, where rates had gone up a lot. And if you remember my comment earlier about this being a floating rate asset class, as rates go up, yields go up in this asset class. You also have credit spreads, which are fixed at the origination of the loan, so that piece doesn't move. But spreads for newly issued loans are going to depend on the market environment. So when there's a lot more money coming in the space, and there's less perception of risk, spreads are going to be tighter. Investors are going to require less spread to compensate them for the risk. When things go haywire, investors want to redeem, and there's a general higher risk perception, spreads are going to widen, and so new loans are going to come in at higher yields. And so you've got these kind of two dynamics that influence returns, but we find that over time, again, you extend your time horizon long enough, and you get a pretty consistent return profile. So again, kind of looking out, our 10-year capital market assumption or expected return for private debt is about 9%. And again, the math of this asset class is a bit more simple than you find in things like stocks, where there's a lot of other variables and more noise and uncertainty, even over medium to long term time frames. If you think about, like, everyone for a long time was predicting lower S&P 500 returns because various types of valuation metrics were indicating things were overpriced, and it goes to show you that valuations, kind of a blunt timing tool. And even over long periods doesn't necessarily give you a ton of predictive value on where returns are going to head. This being just kind of more income accrual, you tend to get more reliability on kind of what to expect over a 5 to 10 year time frame.
Cool. All right, I want to rapid fire one or two quick ones. Rapid fire, what is the latest true default rates inside private credit space, similar to the funds that you guys manage? You don't need to talk about anyone specifically. Maybe you would refer to something like CCFLX, but what are the specific default rates?
Yeah, why don't we we'll use, because our CDLI index publishes quarterly, so the most recent data we have is end of Q4. So we can kind of look at 2025 as a calendar year. Realized credit losses in the index were 64 basis points. That's well below the 21-year average of about 1%.
Yep.
We find, non-accruals, which is essentially loans that have moved to non-cash pay, so that's sort of a precursor to default. That is at 1.3 as of year end, well below the 2.1% historical average. There's a thing called payment in kind, or PIK income. That's essentially borrowers that have moved from cash pay to kind of deferring their interest payments to the later part of the loan. It's not always, but it can be a sign of a potentially distressed borrower. Again, we see that dropped from a year prior to 7% roughly of total income, but below the post-COVID average. And similarly, when you think of rising or falling interest rates, rising interest rates, it's for investors it's nice because it boosts your yield. But if you think of who's on the other side of the loan, it's the borrower. They've got to pay that interest. So when rates rise, their interest payments go up, and so their interest coverage ratios go down. Which, if rates stay high enough for longer enough, that can really potentially interrupt their ability to repay the loan or stay. So what we saw is that with declining base rates over the past couple of years, we've had a few Fed rate cuts. that's helped improve interest coverage ratios to 2.16 times, up from a low of 1.85 times when interest rates peaked. And so overall, again, when I go through those metrics, it's not real time. It's about a quarter lag, but again, things don't change too much day to day, and so we see an asset class that's fundamentally sound, and that kind of makes sense when you think about, again, when the worst times for private credit are going to be during big recessionary periods, and from what we can tell right now, we're in a strong equity market. We see positive GDP growth and a generally healthy economy, and so that should bode well for kind of more of the same in private credit in the near term.
Yeah, perfect. And I think it'll be interesting to see the 26 numbers, because that's where you're starting to get predictions from. Morgan Stanley came out saying we're looking at 8% default rates, a lot of different projections there that are definitely higher than 2%. Fitch came out with their private credit default rates of 5.8% for 26. So you referred to the 25 numbers. It'll be really interesting to see the 26. I think the point of all this too was, if you go get a 9% return somewhere, risk and return are related, right? There is risk associated. Whenever somebody calls you up and tells you I've got the no risk 11% returning investment, you got to wave the flag.
Hang up.
The non-trend flag.
And that's why we try to educate investors. There's an inherent low volatility because these loans don't price daily, that it does smooth the volatility, so it gives the perception of, hey, this is a really solid return with very little risk. And I think my takeaway there is that volatility can be a decent proxy for risk in public markets because those trade daily. It's not a great proxy for risk in private credit. Really, the big risks are implementation risk, meaning the manager you choose can be, again, not all managers are created equal. You might have very different even though the index tells a certain story, if you've selected really good or really poor managers to implement your allocation decision, you might have different outcomes. So manager selection is always of utmost importance in private markets. The range of outcomes between the best and worst performers is much wider than what you find in public markets. And of course, there's liquidity risk. And so I think it goes back to risk is multidimensional. It's not one thing. And even though you're removing some volatility, it doesn't mean you're removing risk. You're taking on implementation risk, liquidity risk, and of course, general credit risk, which can spike at different times like recessions. And so again, I've never been a big believer in market timing, even in public markets. I don't think anyone has a crystal ball as to what the S&P is going to do, where interest rates are headed, and in particularly for a asset class that is held to maturity illiquid loans, and it's just income accrual over time. To try to time moves in and out just doesn't make a ton of sense. So I think you certainly want to go in, again, knowing that there's going to be time periods where returns aren't great, but over time you should expect a pretty strong complement to your stock and bond exposure.
I love it. I think we're wrapping it today. It's 42 minutes in or so. We hope you enjoyed the conversation with Phil Huber from Cliffwater. We are bringing you this source. I mean, this is the tip of the spear, the source of information, if not one of the largest private credit managers in the world. And they're good at what they do. And we've had some great experiences with them. No asset class will go without its challenges over time. We're not here to testify that you should be investing in this, but you should be considering alternatives in private credit and private equity as part of your overall portfolio construction. Phil, thanks so much for your time.
Yeah, thank you.
Here. Yeah, it's been a pleasure. Thanks for having me with you.
Yeah, man, it's fun having you. Thank you so much. Hopefully we can have you back some other time to unpack this level 2, maybe.
Sounds like a plan. Yep.
Especially when this thing shakes out and things are good and it's groovy again, and you don't have to answer concerned client calls every day, right? We can get you back. It'll be fun.
Yeah.
As always, thanks, Alex. It's Financial Detox. We invite you to learn more about how this fits with your personal and specific situation. And the way you do that is you reach out to us and you get an analysis of what you're doing. Look at your financial plan. We'll build the whole template, the whole sample of your financial plan, and let you get a feel for what that looks like and feels like. Help you make better decisions. Be financially detoxified. Manage your wealth for maximum impact. That's it right here. IDA Wealth Financial Detox. We'll see you on the next show. Thank you.